A new monetary system is being built. The Federal Reserve says inflation will return to its 2% target. During the same week, more than 140 companies announced a new digital dollar initiative. At first, those stories seem unrelated. One is about inflation, the other is about digital money, but both point to the same problem. The United States now owes nearly $40 trillion. That debt comes with a huge cost. Every year, the U.S. government spends more than $1 trillion just paying interest. None of that money reduces the debt. It only pays the cost of borrowing. No government wants that bill to keep growing. There are only a few ways to deal with it. A government can reduce spending. It can raise taxes. Or it can reduce the real value of its debt over time. That is where inflation enters the story. For most people, inflation means a higher cost of living. Food becomes more expensive. Housing becomes more expensive. Savings lose purchasing power. For a government with enormous debt, inflation has another effect. Imagine borrowing $100 10 years ago. You still owe $100 today, but each dollar buys less than it did back then. The amount of debt stays the same. Its real value does not. Governments have used this approach before. After World War II, the United States faced a massive debt burden. It did not eliminate that debt overnight. Instead, inflation remained above interest rates for years. Over time, the real value of the debt became smaller. Economists call this financial repression. For most people, it simply means their money buys less each year. Many describe it as a silent tax. Reducing the real value of debt solves only part of the problem. The government still needs people willing to buy its debt. Without buyers, borrowing becomes more expensive. That brings us to the second part of the story. Why are more than 140 of the world's largest companies suddenly building digital dollar infrastructure? The unexpected buyer. The United States still needs people willing to buy its debt. That is why stablecoins matter. A stablecoin is a digital token designed to maintain the value of $1 US. People use stablecoins to send money, trade cryptocurrencies, and move dollars across borders. But what happens after you buy one? Let's follow the money. You buy $100 worth of stablecoins. You send $100 to the company issuing them. The company sends you 100 digital dollars. Your dollars do not disappear. The issuer now holds them as reserves. To back every stablecoin it creates, the issuer invests those reserves in safe assets. Most of that money goes into short-term U.S. government bonds known as Treasury bills. Now, two different people own two different assets. You own the stablecoin. The issuer owns the Treasury bills. The U.S. government pays interest on those Treasury bills, but it does not pay that interest to you. It pays the issuer because the issuer owns the bonds. You hold a digital dollar. The issuer keeps the interest. Most people never think about stablecoins this way. They believe they are simply holding digital cash. In reality, every new stablecoin also creates demand for U.S. government debt. Now multiply that by millions of users. Every purchase sends more dollars to stablecoin issuers. Those issuers buy more Treasury bills. The government gains more buyers for its debt. That is why stablecoins have become important far beyond the crypto industry. They do more than move money. They also help finance government borrowing. Once governments recognized that, many of the world's largest companies saw an opportunity. That helps explain why more than 140 companies are now building products around digital dollars, the law that created new buyers. Stablecoins became much more important after the Genius Act became law. The legislation created a regulatory framework for stablecoin issuers in the United States. Every digital dollar must be backed by real financial assets. A large share of those reserves must be invested in short-term U.S. government debt. That requirement changes the economics of stablecoins. Issuing more stablecoins means buying more Treasury bills. Washington linked their growth directly to demand for government debt. Stablecoins already have a combined market value of around $320 billion. Tether holds about $141 billion in U.S. Treasury securities. That makes one crypto company a larger holder of American government debt than many countries. Some forecasts expect the market to reach $2 trillion. If that happens, issuers will need to purchase hundreds of billions of dollars in additional government debt, making it easier to finance deficits. Then, on June 30th, more than 140 companies announced that they were working together on a new stablecoin network. The group included Visa, MasterCard, American Express, BlackRock, Stripe, Coinbase, Google, Samsung, IBM, Shopify, SoFi, and Ripple. Their proposed token was called OpenUSD. Under the Genius Act, stablecoin issuers cannot pay interest directly to token holders. Users receive a digital dollar. The issuers receive the interest generated by the reserves. Imagine OpenUSD grows to $100 billion. Its reserves could generate billions of dollars in annual interest income. Token holders would receive none of it. The companies operating the system would share that revenue. Washington benefits as well. As the stablecoin grows, its reserves must grow with it. That creates another long-term buyer of U.S. government debt. The companies gain a new source of low-risk income. The government gains another source of financing. This explains why so many of the world's largest companies are entering the business. But there is one final piece to this system. The pieces fit together. By now, the broader picture becomes clearer. Inflation reduces the real value of government debt over time. Stablecoins create new demand for that debt. The Genius Act links the growth of stablecoins to purchases of U.S. Treasury bills. Together, these developments make it easier for the government to finance large deficits, while inflation gradually reduces the debt's real burden. That does not mean every decision was part of one coordinated plan. What matters is that the incentives now point in the same direction. Some analysts argue that this could allow the dollar to lose purchasing power gradually rather than through a sudden crisis. That idea has also appeared in discussions around proposals, such as the so-called Mar-a-Lago Accord. Although no such framework has been adopted as official U.S. policy, supporters argue that a weaker dollar could improve American competitiveness. But the direction of these incentives raises an important question. How should investors think about protecting their purchasing power? What this could mean for investors. If this view is correct, how are experienced investors responding? Many economists and long-term investors tend to focus on three ideas when they expect inflation to remain elevated. The first is cash. If inflation remains above the interest earned, purchasing power gradually declines. Your bank balance stays the same, but what it buys becomes smaller. The second idea is to own assets that have historically performed better during inflationary periods. Real estate is one example. Gold is another. Many investors also look for businesses with strong pricing power. These are companies that can raise prices without losing most of their customers. The third idea comes from the stablecoin story. We saw that stablecoin holders do not receive the interest generated by reserves. The issuers do. It is worth paying attention to the businesses operating around the stablecoin ecosystem, payment companies, infrastructure providers, and exchanges. There is an old saying on Wall Street. During a gold rush, some people searched for gold. Others sold the picks and shovels. In many cases, the companies selling the tools built the more predictable businesses. The same idea could apply to the stablecoin economy. Whether this framework proves correct or not, one lesson is clear. Understanding how money moves may become just as important as where it is stored. If you found this documentary valuable, consider liking the video and subscribing to Financial Cycles. We publish in-depth documentaries on the global economy, financial markets, and the future of money. Thank you for watching. I'll see you in the next one.